Hey, Dad, how do banks work? Well, son, they rent your money by giving you a tiny bit of interest, and then they turn around and rent it to other people for a much higher rate of interest. Dad, what's a tiny bit of interest? Well, son, it's what your mom has every time I tell a joke. It's funny because it's true. But Dad, what if they lose our money? Don't worry, bud. That's why there's the FDIC to insure us. An insurance company? Well, I mean, not exactly. It's the government that insures us with the taxes we pay. Is that why they give you a lollipop, sucker? Because you're a dum-dum? Now, I wasn't sure if I should kick him out of the car, just add him to my financial team. Again, stupid genius. Did you ever notice how banks have the largest buildings in every city? Every single city. I guess we owe our skylines to the banks. You know they don't have any products, right? I mean, do you have a special room in your house with a massive safe that you could walk into just to store your money? And by the way, the majority of the bank's money isn't even stored there. It's just on computers, right? Plus, why are their buildings so tall? Like when I walk into the bank, I just go on the main floor. What's in the upper floors? Spas? Empty rooms to display power with a conference table? Artwork? I don't get it. Why are banks so profitable, and how can understanding the way they deal with money help you with yours? Well, let's dive in. First off, banks are all about cash flow. Cash flow is the amount of money that's coming in every single week or month or quarter, but it comes in consistently. It can also be called recurring revenue. Banks don't take your money and go, oh, I'm going to store this away for 30 years in some retirement plan. That's not how it works. Just look, when you go into the bank the next time, look at the advertisements while you're there. One might tell you the measly tiny little interest rate that you get, and then tell you the interest rate they'll charge you to borrow money. So you're getting a teeny tiny bit when you deposit there in money markets, savings accounts, certificates of deposit, yet they're saying, hey, here's the car loan rate or the mortgage rate or a signature loan rate. And this is a massive difference. Even if they're giving you a huge return for them is 1%, right? That's not what most people are getting in a savings account. That's a lot more than they're getting. But they're saying, hey, we'll give you a mortgage at 5%. Think about it. 1% to 5%. If you could buy something for $1 and sell it for $5, that's a 500% markup. They're making huge returns. The other thing that they try to do, by the way, is they try to get you to shorten the loan because they're in the cash flow business, not the accumulation business. The more cash flow they can get, the better, because then they can always try to get you to get a new loan. They also want to give you a better interest rate if you give them collateral. Why? Because banks are great at managing and mitigating risk for the most part. That's also why they want to look at your credit score. The better your credit score, the more options you're going to have, maybe even a lower interest rate. So banks mitigate and manage risk, and another way that they do that is when you want to get a loan. They say, hey, if this is a mortgage, we want a down payment, right? And the bigger the down payment could even change your interest rate. See, if you're less than 20% down payment, then you might have private mortgage insurance, which is an insurance you pay for to protect the bank. Speaking of protecting the bank, they want you to get appraisals. Now, if it's a jumbo loan, that's multiple appraisals. If it's not a jumbo loan, it might be one appraisal, but you pay for it to verify and validate the asset they're lending against, which is part of their backup plan in managing risk. They want to look at your credit reports. Have you paid late? What's your score? Is it above 760? They're looking at all this to determine your interest rate or if you're a worthy borrower. Excuse me for just a second. I know I'm interrupting your video, but it's because I'm really excited about this. Disrupting Sacred Cows, my newest book. It's new, it's fresh. It's about all of the things that have to do with our relationship to money, the things that hold us back, and how to, kind of peek into that, be able to resolve that, and ultimately, with the new economy and everything that's happening and moving so quickly, it is timely to help you to have more success in your finances. So go ahead and click the link if you want to grab this book and dive on in. They also look at seasoned funds, which are money that you've had in savings or money markets, and the longer they've been there, they got to be there at least a few months to count, right? Because they don't want you just borrowing money, putting it in the account and then just when you get the loan, give it to someone else. They're saying, has this money been there for a while? We mentioned private mortgage insurance. That's another thing to protect them. And they'll incentivize you to shorten the loan, like I mentioned before, by lowering your interest rates. So banks think like this: cash flow, cash flow, cash flow. And what they're really trying to do is something called arbitrage. They're saying, hey, we'll give you 1% and we'll go rent that money out to someone else for a much higher interest rate, right? That's arbitrage. If I could buy something for $1 and sell it for $2 and do that automatically on the internet, that's arbitrage. If there's an inefficiency, I buy one currency and convert it to another currency and back to my own currency, and I make money, that's arbitrage. So arbitrage is what they're in the game of. See, they don't go put their money in the stock market. That's way too risky. And if you try to go get your money from the bank and borrow, which people have done, oh, I'll go get a loan, I'll go put it in the stock market. Well, when they say the stock market's average a certain rate of return over a period of time, they're not taking into account volatility, which can impact your rate of return. If I lose 10% and I have $10,000, I'm at $9,000, then I make 10%, that's only back up to $9,900. Plus, there's fees on those investments. So don't just go borrow and then go invest in things that are speculative. You know, for you to arbitrage, you probably have to really know your investor DNA, your values, your competencies when it comes to money, your drivers, the things you're willing to pay attention to, and then get really focused. See, banks focus. They might have a repertoire of loans and different types of loans they do, but they're really not that good at real estate. They're not really that good at all these other things that a lot of people diversify into. And when someone's trying to invest, and all of a sudden they're in cryptocurrency, and they're in tax liens, and they're in day trading, and then they're in mutual funds, and then they're in commercial real estate, it's hard to get good at things when you spread yourself thin. Banks are really good at lending money and managing and mitigating risk around that. So in your own world, how can you learn from them? Well, focus, don't diversify. What thing do you want to get really good at when it comes to investing? Then ask yourself, how do you reduce, manage, and mitigate that risk? So if you're lending money, can you get a personal guarantee when you lend it? Sometimes banks do that to people. If you're investing in a market, can you have a trailing stop loss that says if it goes down by a certain point, you automatically move to cash? Trailing because it keeps growing and you don't just want it to have to go all the way back down to where you started. Or just add collateral. Banks love it when you have good collateral. They'll give you a lower interest rate, whether that's a car, whether that's a home, versus a signature loan with no collateral, or a credit card with no collateral is a much higher interest rate. So what can you do to start creating cash flow? Well, part of this is focusing on economic independence more so than accumulation or retirement. Economic independence is having enough cash flow to cover your basic expenses coming from assets. Those assets could be real estate, or it could be businesses, or it could be intellectual property, but it's income that comes in every single month, even if you don't do something every single moment or every single day. So you want it to become passive income because you actively look for the right investments aligned with your investor DNA. When you focus on cash flow instead of accumulation, you're thinking more like a bank. Focus over diversification, you're thinking more like a bank. Banks, again, only diversify their types of loans, but stick to the businesses that they know. They're terrible at real estate. There's something called REOs, or real estate owned. It's when the bank takes over a property. There's short sales. The bank takes over a property. Anyone that's ever tried to buy these things finds out it's excruciating. It's terrible. It's not what they're built for. They're really lending money to you, the individual, and then using all these other factors, like private mortgage insurance, like appraisals, like your credit score, like your seasoned funds, to say, are you going to be a good investor or person for them to invest in? And if you make a mistake or have a terrible life situation happen, they've got things to back it up. So in your own investing, what are your backup plans? What are the things you can do to create more cash flow? For some people, it might be just paying off loans because the banks are so good at creating cash flow for themselves. Maybe the cash that you're paying them is better off just paying off the loan so that you don't have that cash outgoing. Now, right now in times of inflation, some people like to have loans because each year it feels like that payment's easier and easier. But at the same time, if you're only earning 1% but you're paying 5%, the best return you can get is just pay off that loan. Other returns could be investing in yourself and your skill sets. For some people, they like to create cash flow with real estate. Others, they like to do it with business. I like to do it with the intellectual property, books, video courses, things like that I help people around money. This very video right now is intellectual property. So that's outside of the normal realm of where most people invest. But how can you think like a bank? More cash flow today, protecting the downside. How can you create that cash flow? Well, one could be through efficiency. Save on tax, save on interest, save on investment fees that aren't performing, save on insurance costs because they aren't structured right, and get really intelligent and watch and navigate the channel here, and I'll show you ways to keep more of what you make. Or you can expand your means. Expanding your means can create more cash flow. If I buy a business and I have an intelligence in that business and I can earn more money by adding more value, that can increase cash flow. That's about making more money. Most people get stuck in the accumulation mindset of set it and forget it, invest early, often, and always, scrimp, sacrifice, save, defer, delay, and then wait for 30 years. Banks would never do that. Get into the game that's rigged for you, not against you. The banks are telling you to do one thing while they do another. It's not about retirement planning and retirement plans. It's about cash flow today. It's not about investments that you know nothing about. It's about investing in yourself. It's about plugging your financial leaks and keeping more of what you make, and therefore becoming more financially independent and taking back control of your financial life. Think more like a bank, not by setting up false accounts like Wells Fargo did back in the day and charging fees, but from mitigating risk and building cash flow, and you'll end up financially independent. Hey, hopefully you like this format. A little bit of a joke and then some content. I spent a lot of time researching and writing and making sure to deliver value. So if you like this American Dream concept, that you want to get past the myths and misinformation around finance, we'll go to the next video and discover even more.